Thank you so much, Sonia. And good morning, everyone, and welcome back. Welcome back to Sonia for our first work day of the week. I'm very excited. Yes, I am solo today. I'm very excited to deliver all my knowledge on credit today for you guys. So thank you again for joining. On our next slide, I wanted to cover the agenda of the day. So with it's going to be an hour today, and you heard from Access Sonia's welcome remarks, and shortly I'm going to discuss RBC and RBC meeting place, tell you a little bit about who we are, and then our main presentation, which is getting credit and building good credit habits. And then we will also have a question and answer piece. So feel free to enter your questions in the uh, Q&A, in the chat function, and I will get to them at the end. And then we will have a wrap up, and that will be our full hour today. So like I said, I wanted to share a bit about RBC and RBC meeting place, but also myself. My name is Ria Ragbir. I am a banking advisor at RBC meeting place. When I came to Canada, I also had my challenges and I needed to quickly adapt to my new home of Canada. And I'm thankful to have joined RBC that same year. And at RBC, I was able to build my personal and my professional connections. Now, as a banking advisor, I'm essentially the connector to the key services for the newcomers. And we're here to help our newcomers thrive. And that's what we do at the RBC meeting place. We have a wide range of community partners, Access Employment being one of them, and extensive resources that we can call upon to help us connect our newcomers depending on their need. I truly enjoy being present in the community to create such awareness, especially because we get to work with organizations like Access to empower the newcomers, especially with our financial literacy event of credit session today. And on our next slide with RBC, just to tell you a bit about our organization, we are an organization of 80,000 employees. So we're all guided by one set of values. First and foremost is the value we place on our clients. We put our clients first each and every time. We collaborate with our partners, both internally and externally, where we work as one RBC to make sure our clients and our communities prosper. I'm very passionate about our strong value we place on diversity and inclusion. To me, it's more than just a value as an organization. It is the strength of RBC. It is one of the ways we bring RBC's purpose of helping our clients thrive and our newcomer community prosper come to life. We strive to be among the world's most trusted and successful financial institution. We're really proud of the progress we've had so far, and we're motivated by the future and what's to come. We know that everyone at RBC has a different experience, a different perspective, and we work to leverage this to create a safe, productive, and inclusive workplace to support our community where we live and work. And just a bit about my team on the next slide. I do have a small team, as you can see, including our community market manager, Jeff Price, Nazanin, our assistant branch manager, and myself. We are a small team. We work together with the same objective of wanting to give back to our newcomers and our community. However, we have an extensive support team on our next slide, as you can see. It ranges from different departments, different branches, but collectively we possess many different skills and expertise where we're brought together as one RBC because we share the same passion, again, of wanting to pay it forward and give back to the community. And our community partners on our next slide is we have quite a few, and we're so grateful to be and proud to have partners like Access Employment, who's one of our key partners throughout this journey. Together, we can reach out and have those meaningful connections and just make a greater impact in the community. And our advice events on our next slide. Since we opened our doors early in 2019 with our special branch with Access Employment, we've been able to create awareness through our events and our community involvement. Here are just a few of the in-person ones that we've had at our joint branch and just throughout the community in person that we've hosted and facilitated. But on our next slide, if you fast forward to March of 2020, we've taken our reach digitally, where we facilitate all our events, just like today. We've had many, including financial literacy events ranging from investments, from mortgages, fraud prevention, job search, role discovery. We give a little glimpse of RBC, the roles within RBC. We have tax advice events. And today we have our credit event. With these events, we're able to provide a deeper understanding and give the advice that really and truly goes beyond banking. At the meeting place, my colleague Nazanin and I were both advisors at RBC, and we can help you with all your banking needs, answer your questions, especially for our clients that have recently arrived or clients that are planning their arrival. We connect with them in their respective country when they reach out to us. And we help you take care of your banking needs, pre-arrival and post-arrival as well. We also help clients while they were in quarantine. We're just a quick video phone call away. So just now that's a bit about RBC and RBC Meeting Place. So now you know who your guest speaker is today. And just to get us started on credit, I'll jump right into it, Sonia, in the next slide. For those of you that are familiar with the basics, just consider this a refresher course if it is. I wanted to share the textbook definition for credit. And in its simplest form, it is a way to borrow money. It's the ability to get something before paying for it, but you're promising that you're going to repay it in the future. So with credit, there comes a few players. So I'll cover that on my next slide. First up is the borrower. So the borrower is the person actually receiving the money or the goods or the services, and they are the one promising to pay it back. And then on the other side, you have the lender. So the lender is the person who's willing to lend the money to the borrower for the goods and services, and they're going to be paid back later for it. And the amount that you borrow is called the principal. So I'm sure everyone in this on this call today has probably lent money, maybe to a friend at some point, big or small. The amount is called the principal. So let's give an example. That friend asked to borrow $15. So I'll cover some factors that, when somebody wants to borrow money, that, what those factors are on our next slide. So some things that you would want to consider when you lend money. You would ask yourselves, are they a trustworthy friend? Are they going to keep their promise to pay it back to me? Will they have the money to pay you back at a reasonable time frame? Will it be a few days or a few weeks? Now, say for example, that $15, they actually asked you for $500. That's a little bit different, right? So $15, you might think, okay, I don't need it back that urgently, but you may run the risk of that friend, not being able to pay you back, like I said, in that reasonable time frame. But and that $500 is a different story. So you may not want to run the risk of not getting it back in case you need the money for yourself. So think about now that 500, now it's 5,000, now it's 500,000. Now you can see that lending larger amounts of money can be a lot riskier. So those are the things that lenders think about, and lenders being banks or another, like I said, any financial institution. These are the things that we consider before we lend money. And on our next slide, lending, it does come at a risk. Lenders charge interest for the risk of lending their money. It's typically a percentage of the amount borrowed, or as we are calling it now, the principal. So it compensates the lender, the bank, for the risk of lending it, because there's always a risk that they may not even get it back at all. And that's why we charge those interest rates. So the most important rule of borrowing, and everyone must know, is that it's never free. You always have to pay back interest. So on our next slide, I wanted to cover what a credit card statement looks like. Yep, thank you so much, Sonia. So it's important to know how to read your credit card statement so that you're not missing any due dates, and you're not paying more than you have to in interest. It's ideal. the ideal is to pay your full balance off by the payment due date. But if that's not possible, you want to make sure at least you're paying the minimum payment. And I've sort of circled those three things there on the slide, as you can see. And paying off just the minimum payment before the due date, it doesn't really impact the balance, but at least you're making the payment. So if you can, just make the minimum payment if you can at that time. And then I want to dig a little bit deeper into the credit card statement, excuse me, the different terminologies on there. So on our next slide. So when really and truly, when should you pay off your credit card? The short answer is before the due date. No questions about it. Just here's a breakdown of some of the dates for a better visualization of a statement. So your statement in this example, the statement period is monthly with the credit card. And in this picture, it runs from March 6th to April 6th. So now after you have made the purchases within that time frame, you have until April 27th. So April 27th is the due date to pay it off in full if you can. So from April 6th to April 27th, that is actually your grace period that you have. And as you can see it on there, the grace period is typically 21 days. So if you pay it off in full within that time frame, then you don't accumulate any interest on your current balance amount. So your statement balance is an overview of all your purchases and payments that you've made during that one billing cycle. So again, the billing cycle in this example is March 6th to April 6th. So that is your billing cycle. So every credit card has a billing cycle, or you might hear interchangeably a statement period, which can vary for many card users. So you can check with your statement, and for that billing cycle dates and the details in your cardholder agreement. But be sure, but just know that it's typically around 30 days. Another key term to pay attention for is the minimum payment due. That's actually a percentage. So the minimum monthly payment is the lowest amount you can pay on your revolving credit account per month to remain in good standing with the credit card company. So the amount of the minimum payment is calculated as a small percentage of your total credit balance. And then you will see the current balance on this credit card statement as well. It is the amount that you owe on your account minus any pending purchases that you also have on there. So all of the purchases you've made have been processed by your credit card company since your last paid your bill. So I know there's quite a few terms that I'm throwing in there. So please reach out to me if you have any questions about your credit card. Now, there's their available credit, which refers to how much money you have left to spend. Say, for example, it'll say your available credit is $1,000, but your credit card limit is $2,000. So because you've already spent $1,000, now your available credit is only $1,000. So this is the amount that's calculated by subtracting the borrower's purchase and the interest on those purchases, if you have any, from the total credit limit on the account, like I said. So it's that $1,000 from that $2,000, so you have $1,000 left. Another thing that I wanted to cover on my next slide is we get a lot of questions about this, is the difference between the credit card and the debit card. Because when we typically open a account for newcomers and any standard account here in Canada, it does come with the debit card and it does come with the credit card. So the difference is a credit is the money that is borrowed most commonly in the form of a credit card. My apologies, I'm getting one of those scam calls. Debit draws the money that you actually have on your bank account. The most standard bank accounts will come with the debit card, as I mentioned. Physically, the credit card and the debit card, they're shaped the same, they look the same, they're all embossed with your name and everything. But one is a debit and one is a credit. So again, the credit card is purchases with money that you're borrowing, and then the debit card is purchases with the money that you actually have in your bank account. So you go to Tim Hortons and you spend that $5, and then you tap your debit card. That $5 is immediately withdrawn from your account to pay. With the credit card, you tap and you use that $5, then that will show up in your statement and you pay for it, that coffee at the end of the month, depending on your billing cycle for sure. On our next slide, I wanted to cover the most popular types of credit in Canada. And, we'll focus more on the credit cards, just in essence of time. But the credit cards is first and foremost. Then we have personal loans, and we also have lines of credit. So just to cover a bit about more about the credit card, on our next slide, let's go through some of the tips here on for the credit card. So credit cards, are for the smaller purchases and that online purchases, like the Amazon, the Apple subscriptions, typically is what we use for the online. And especially during COVID, we've all used our credit card a bit more. I can vouch for that. I booked my trip last week for my Christmas vacation with my credit card. So, typically that's what we use the credit cards here for. So, a secured credit card. What does this really mean? This typically means that you have to put up collateral to qualify for the maximum credit card limit that you've been approved for during that application process. So collateral is typically asset like a car or that you own outright or a piece of property. Typically it's an investment, but most of our credit cards are unsecured, but if you do have to have a secured one, typically it's against a investment. Credit cards typically charge a higher interest rate, generally between 10 to 20% for two reasons. One, because the credit card loans are non-secured, as I just mentioned. So non-secured meaning that you don't have to put up the collateral against it. But we do have clients I'll cover a little bit later, clients do have to have secured one based on their credit history. So that's a unusual case, but we do have secured ones, but typically they're unsecured. And then for the second reason is to offset the risk that the borrower may not pay it back. So that's one of the risk factors. So that's typically why we charge a higher interest rate. So this is one of the biggest one for credit cards, that we do run the risk of not getting paid back. So essentially a credit card is a loan. So you are, you're paying this loan back, and if you default on it, then we actually were able to get the money back for it. Now, the term refers to the annual fee on your credit card, which is typically once a year. So the annual fee on a credit card, depending on the credit card that you have, you do get charged for the credit card, but we do offer non-fee based ones to our newcomers just to get them all set up for it. Payments on your credit cards are due monthly, more specifically every 21 days. It's important that you keep track of these due dates by checking your statements online or setting up any payment alerts as well for the credit card. I'll talk about those in a little bit too. So a smart way to avoid paying interest is by paying off your balance in full if you can, or the amount that you've actually borrowed. And that way you don't get charged interest on the credit card. If you can afford to pay the minimum payment required by the due date, it's important to include the principal plus the interest charges if you can. And if you miss your payments altogether, sometimes bank will increase your interest rate, usually until you make your minimum payment again, and then that rate goes back down. So again, just to reiterate, if you miss the payment altogether, the bank, and you do it consecutively, I think it's up to like 3 times, then the bank will increase your interest rate. So just know the interest rate is already high. And if you've missed payments, then they can actually increase it and make it higher than what it's already is. And on our next slide, I wanted to actually cover what's really, really important when choosing a credit card. For me, it was the rewards points, but I recommend that you sit down with your advisor or call on Naz and I, and we can discuss, the best credit card for you, depending on your needs. So credit cards, they come back. There's a lot of perks and benefits with it. So you want to make sure you're choosing the right one for your lifestyle and for your family's lifestyle as well. The reward points. So, for example, my trip that I booked to Florida required 30,000 points, and that way I can get my ticket for free. So that's important to me. So I accumulate points, and I can use those points to book my flight. Cashback is important to some clients. So you make purchases, you get 2% back, and then you accumulate this, and then you can use that to pay back your credit card. So whatever works for clients, we do have the different credit cards for that. And there's point system, there's the cashback system, there's travel insurance coverage, there's extended warranty, there's low or no annual fee one, like I described for our newcomers. We do have the new no annual fee ones. There's low interest rates as well. I remember, so the extended warranty. So typically when you buy something, it comes with 1 year manufacturer's warranty. So purchasing it on this particular credit card can extend that warranty another year. So those are things, like I said, there's so many benefits that comes along with credit card that you want to be mindful of and just really pay attention. So know it so you can maximize the use of your credit card. And on our next slide, I wanted to talk about getting credit. So if you can just move on to the next slide for me, Sonia. So why would someone really want access to credit? There's many reasons. You're hearing me talking about credit, and if you're in your respective country and you're not using credit there yet, coming to Canada, you're going to be exposed to it. It is going to be something that you're going to have to get used to because it's very, very important here in Canada. So maybe you want to buy a new car, or maybe you want to start your own business, or there are classes that you want to take. Maybe you need to borrow for rent. There could be many, many different reasons why you need access to credit. But on our next slide, when clients come to us and they want to borrow money, RBC and many of the lenders, we look at different factors. We call them the 5 C's of credit. So first and foremost is your character. So that is how responsible you are when it comes to managing your finances and taking responsibility for your debts. And then the second C is capital. It's the amount of money you have available to you from your savings, from your investments, and so on. And then your capacity is your ability to repay this debt at a later date. Your collateral, such as the assets that you can provide as a security for the loan. Like I said, this will include real estate, investments, or even your car. And then the final factor, and you will hear me talk about this one a lot, the final factor is your credit history. Which is essentially your track record for repaying all your loans and paying your bills on time. So this one you'll hear me talk about a lot. They're all very important when we assess clients for lending, but credit history is, in essence of time, I'll talk about the most today. So why is credit important? Again, on our next slide, the moment you start using any type of credit, a credit report gets built in your name, and anytime you apply for credit, the lender can access the report and see your credit history, your history of being able to pay your bills on time. So your credit report lists identifying information about you. It lists your name, your current and your previous addresses, your social insurance number, your telephone number, your date of birth, and your previous and current employers. It lists your credit cards. It lists all your loans. It lists how much money you owe on each. It also tells us if you paid your bills on time or if you were ever late. So again, why is credit important? Because businesses want to know about you before they actually lend you money or lend you more money. So think about it this way. Would you rather, lend money to someone who always pays their bills on time or someone who is consistently late with their bills? So businesses look at credit report to learn about you and decide again if they want to lend you money or give you that credit card. Another thing to note that sometimes employees look at your credit report when you apply for a job. Cell phone companies and insurance company also might be interested in your credit report. I remember when I first came to Canada in 2008, they actually pulled my credit for a cell phone, and it still shows up on my credit report from Rogers that, I've had this inquiry for a cell phone in 2008 when I first got my cell phone here in Canada. And on our next slide, I wanted to cover two things with you: credit history and credit score. You'll hear me talk about that and use it interchangeably as well. I wanted to share the difference with the credit history and your credit score. So your credit history is your financial reputation in Canada. It is a picture of how well you manage your money, whether you've paid your bills on time, and what your outstanding debt is, whether you've missed any payments. So now over time, this data forms a pattern of how well you pay or don't pay. Anytime you've applied for a loan or a credit card, lenders will look at your history to help them decide whether or not they should actually accept your application. Now, landlords for when you're renting may look at it too, and to see the kind of person that you are, if you're going to pay your rent on time, because they can actually look at this and kind of have an idea of who you are at that time, because they also want to see your track record. So that is your credit history. So now your credit score is the number that's attached to it with a grade, as you can see in my grading scale here. So a credit bureau score is a tool used by banks and other companies to determine how risky it is to do business with you. It gives them a picture of how well you manage your money based on the information pulled from all the different lenders that you do businesses with. So the better the credit score, the more likely you are to qualify for a loan or a mortgage you're applying for. In simple words, your credit score is the number assigned to you that shows your ability to borrow money and to repay it later. Again, as you can see, the higher the score, which is the A, the better for you. In Canada, credit score ranges from 300, which means you're just now getting started or you haven't been responsible, and then it goes all the way up to 900. So according to TransUnion, which is a reputable credit agency, 650 is the average score for most Canadians. And that's typically, where I've seen many of the newcomers start off with. And then they work their way up to the A scoring. Credit scores may be a evaluation of your credit worthiness in one way or another. In that sense, the scores are very much like your grades. You are in control, and good, healthy, credit habits, it does go a long way. So to calculate the score, a specific set of rules are applied to an algorithm which draws some assumptions about the individual, your spending habit, and then assigns a number to that score. So lenders may use your score to set the interest rate on that credit card or on that loan. They can use it to set the credit limit as well on that loan and the credit card. So if you have a high score, you're able to get a lower interest rate on a loan, and you can save money over time. A good credit score can help you qualify quicker and easier for loans. So that's essentially a bigger savings for you, because you can, pay lower interest rate and have a greater repayment flexibility than someone that has a low credit score and poor credit history. So there are two credit bureaus in Canada on our next slide. As you can see, it's Equifax and TransUnion. So credit reports are free every 12 months. And you should be able to request your credit report at least once a year to make sure the information is true and accurate, because creditors are and sometimes even employers can request this report. So you want to make sure it represents who you are. You can also request your credit score from TransUnion and Equifax, but there is a charge. So just to reiterate, the credit report is free every 12 months, but the score attached to it does come with a small charge, which is why I'm happy to tell you, and for our clients that bank with RBC, you can actually see your score through your online banking. So let's take a look at that on our next slide. All you have to do is to log on to your RBC online banking, and under My Services, you'll find a link that says View Your Credit Score. It'll show you your actual TransUnion score. So this is just a snip from online banking, and you can see, where you stand. You can see the grading scale. It's all color coded, and you can click on the credit report to see a summary of all your accounts. Personally, I like to check this on myself every quarter just to see my score, because I'm very competitive. I like to see if it's increasing or decreasing. And I like to see also and ensure that it does reflect who I am, make sure my information is correct on there, my name, my address, everything is correct on there. I want to also make sure there's no new lenders that I'm not aware of on there, because I know I have one credit card. I have my mortgage. So I want to make sure there's nothing new on there that I'm not aware of. And it does list everything there for you to see. And my second picture there is a score simulator. So when you scroll down on the online banking, the score simulator lets you play around by adding a credit card or adding a loan and increasing your credit limit. So you get to see how it will affect your score. So if you increase your credit limit, you'll see how that affects it. If you decrease your credit limit, you'll see if you plan to apply for a mortgage, then you can see how that's going to affect your score, because everything you apply for does affect your score. But the great thing is that your score does go up, after some time. So yes, the initial impact affects your score, but then, with great repayment history, then your score does get built again. So I want to take a deep dive into what actually impacts your score. So on my next slide, I have a great pie chart there. As you'll see what impacts the score. First and foremost, in my biggest pieces of the pie there is payment history and credit utilization. So payment history, if you pay your bills on time, paying your bill late, or having the account sent to a collection agency does have a huge impact on your score. And then the other is credit utilization, sometimes called balance to limit ratio. So in other words, don't max out your credit. Try to keep a month-to-month balance of less than 50% of your credit limit if you can. So if you're, again, $2,000 limit on your credit card, try to keep a month-to-month balance of that $1,000 if you can. We do know that some newcomers, when they initially land, they have to make purchases for furniture and different things to get all set up. So if you, one-offs are okay, but if you consistently do it, it does impact your score. Other factors are new credit application. So I mentioned this, if every time you apply for credit, it impacts your score. So have you shopped for new credit recently? Are you applying for credit with different lenders within a short period of time? That can lower your score, especially if you have a relatively short history to begin with. So sometimes, and we've seen this with our newcomers, they're getting set up, they're getting a car loan, or they're getting their renter, their landlord, is asking for their credit history, and they're able to see the type of person they are. Sometimes they do ask for it. So we see where they apply for different credit facilities within a short period of time, and that does decrease the score. But again, you're just now starting in a new country, so the score is only going to go up from there. So just be mindful of that. Credit variety does impact your score. So how balanced is your mix of credit? A healthy credit profile has a balanced mix of credit accounts and loans. So not just, credit cards and not just loans, you have a balance and a mixture of both. So generally speaking, the more types of accounts that you have, so credit cards, retail accounts, mortgage accounts, installment loans, as well as the total number of accounts that you have influences your credit score. So again, a healthy mix is pretty decent, not just, all credit cards, all installment loans. Account history. Having a longer account history on your credit account earns you more points. So avoid closing your accounts if you may need them in the future, because a good credit history does take time to build, and you want to make sure you have those accounts open, and that you are using them, and essentially paying them off when you do use them. Too many accounts, having access of too much credit, like having that multiple credit cards or multiple loans. Just have a decent number. Personally, I've been here in Canada for quite some time, and I have one credit card, and I manage very well with that. So just know what's best for you and your family, and try to maintain your credit within that. Because having multiple credit cards without loans can be a warning sign of financial distress. So we've seen where clients they're constantly applying for credit cards, and not just with us, they're applying at the different banks, and they're applying for loans at different banks as well. And then they come to us, and then we can see everywhere they've applied. We can see that they applied last week or a month ago. And that can be an indicator of financial distress for us. So then we sit there and we think about that 5 C's, my few slides ago, and we think about that. Oh, this person's in financial distress. Do I want to give them more credit? Are they going to be able to handle it? So these are the things that we think about. So it can make you appear to be in financial distress, and then we contemplate giving you more. So even if you aren't using that credit card, the bank will look at the credit that you actually have already and think, why do they want more credit? And then we use that to evaluate your financial health. So now that you know what credit is, what impacts your ability to get it, let's take a review of some best practices around credit. Thank you so much, Sonia. So not all debt is created equal. So there's good and then there's bad. So I know I'm throwing a lot of terms at you right now. There's risk, there's interest, secure versus non-secure, poor credit score, good credit score. I'm not here to intimidate you. I'm just here to, just educate our newcomers, as they arrive, about credit and how important it is here in Canada. So just to cover, the good debt and the bad debt, I'll do so now. Good debt is an investment that will grow over time with you or generate that long-term income. It generally has a lower interest rate. So an example would be taking out a student loan to pay for an education that will get you a great job in the future. It's a perfect example. Another example is taking out a loan to start your own business, so you have control of your own career. That's another example. And of course, buying a property that will only appreciate in value are good examples of good debt. Now, on the flip side, bad debt is debt incurred to purchase things that quickly lose its value and do not generate that long-term income. Bad debt is also debt that carries that higher interest rate, like the credit card. The credit cards are usually the highest because, like I mentioned, it goes 10 to 20% typically on credit cards, and that's about average. Some goes actually higher. And then the people that that missed a few payments, it can get actually increased as well, as I mentioned. So bad debt is more expensive to borrow, which is why it's especially important to pay it off on time. And I'll cover that on my next slide. So building good credit with good credit habits. So first and foremost, I recommend, excuse me, that you start early to build your credit. Paying your bills on time. The alternative to paying your bills late or having them go to a collection agency can have that negative impact on your history and your score. It actually decreases your score a lot. Setting up alerts can help with this because it gives you a text message saying that your bill is due. Setting up alerts for everything that goes in and out of your account, so you are able to better monitor your credit account, not just your credit account, your checking account as well. Having a good, I would say, a relationship with your banking, your online banking and your mobile banking is crucial because you want to be aware of what's going in and out of your account. And that will really help you, remember those due dates. Because you can set up reminders for that. I personally like getting a text message saying my Rogers bill is due or my Rogers payment got paid, because I know that I'm covered. Reduce your debt if you can. So pay more than the monthly minimum, again, if you can. Prioritize paying off the higher interest debt first, such as those credit cards. Because credit cards, for example, is costing you more in interest than the other loans or credit lines that you may have. So by paying those off first will reduce your overall cost of borrowing and keep your debt at a manageable level. And another great tip is to correct any errors on your credit report. So as I mentioned, RBC, we do offer that monitoring for free on your online banking. And I mentioned I set up myself a reminder to check it once a quarter, or sometimes if I'm just looking around on my online banking, I can just pop in there. It's just a tab under the My Services View Credit Report, and you can see your score immediately. I personally enjoyed checking my score after I paid off my car loan, because it did bump me up about, I think, 15 points on my score. So it was great to see that. So just, set up reminders to do that, monitor it, check with your respective bank to see if they offer it. Obtain that free credit report, annually, again, to check to make sure it reflects who you are. Use your credit card responsibly. Use credit for things that you're going to be able to pay back. Start early, but be patient, because good credit takes months or sometimes years to build your good history and a good score. And it's important, which is why it's important to learn the necessities now. We try to educate our newcomers upon arrival for it. Just know we're always here to answer your questions. We're always here because I've met many clients where credit is very new. They don't have credit in their home country, so it's very new to them. And just knowing the basics now can really help you set up a good financial profile here in Canada. And just keep in mind, again, every time you apply for new credit, it shows up on your score. It does let us know. So if you apply for credit in different areas, different banks within like a 5-day period, it will show and tell us. Protect your finances. Keep your financial records in order, and always watch out for fraud and scams. I mentioned monitoring your credit report, just because you want to protect it and make sure no one has stolen your identity. So you want to, again, make sure it reflects who you are. And that's the purpose of checking it periodically, to make sure, it does have all the information that corresponds with you. I know it can seem overwhelming, but just make sure you're doing your best, to pay your bills on time, and check in with your credit, check in with your banking advisor to discuss more. And, I will share my contact information, my colleagues' contact information. It's on our next slide, Sonia. So if you can just move it to our next slide, it does have my contact information there. And this actually brings us to our questions and answers piece. So I'd love to hear your questions, and I'll try my best to answer them. Thank you, Sonia. Let's take a look and see if we have any questions here. Feel free to enter them in the chat function, and I can definitely get to them. And again, thank you all for attending. The criteria for getting a line of credit. That's a great question, Clive. So a line of credit, the same procedure for getting a credit card. You would have to, I guess you're asking from a newcomer perspective. You can definitely sit down with your banking advisor, your financial advisor, and just we would pull your credit. You would produce any statements that you have for your payroll if you are already working. These are the things that we would need for to apply for credit. And we would do the application on site with you, or virtually in this case. Oh, here's another question. Thank you. What if a bank does not get back to you if you're trying to get refinancing on your mortgage? Okay. So that's more so, you would reach out to your bank. You should have their contact information. Just reach out to them and tell them you want to know the status of it, and let them know that it's really important to you and you just want to know what's going on with the application. You should have their contact information if you already reached out to them. Okay. Thank you, Clive. I think you really need to check with your bank for that. Just I'm sure you have the contact information. So just reach out to your respective bank and let them know this is what you want to do, and you would appreciate a call back. Mazine, thank you for a great question. You have a question if the credit score will be affected if we just pay the interest on the credit card. So you want to make sure you are paying the minimum payment, because it does take a percentage of all your purchases. So if you can make the minimum payment, if you can pay it in full, that would be great. But if you're just paying the interest, you're not paying anything towards the principal. So at least you're still making a payment, but you're not paying off the credit card, and the interest is being compounded on there, and you're just paying interest upon interest on there. So you want to be mindful of that. But bottom line is that you're making a payment, so that's important. So at least your credit score will be in good standing. I hope that answers your question, Mazin. Thank you, guys. Keep sending in those questions. How much does credit score come down by if someone applies for a new credit? I've seen it range from about 10 to 20 points. It gets affected, but it depends on many factors: how much you apply for, how often you apply. So different things does affect it, but I've seen personally about 10 to 20 in that ballpark is how much it gets decreased by. But as I mentioned, it will increase when you're making your payment. So you'll see it increase quicker. When it decreases, it's just that one point where it gets decreased when you do the application. And then, it does increase a lot faster. So it's great, having access to it, to see it on your online banking, where you would see the score. And like I said, you can check it at any point. And just to answer the other question, it ties in. Checking your own credit score, it doesn't get affected, because when we produce it on our online banking, it is the information that we have pulled from TransUnion that we are presenting on your online banking. So you're not checking it per se, where you're doing like a hard check. You're more so just seeing the information that we've already pulled and put it on there for you. So it's not considered like checking it. You're seeing it what we've presented to you, and we've pulled the information from TransUnion because we have that relationship with them where we can produce the information to you, so it doesn't affect your score. If you check it, you can check it daily if you want. The score, you won't see anything changing unless you've applied for something like last week, but you can definitely look at it all the time. I check it anytime I go in, but I try to go once a quarter at least. We do have some questions in the Q&A. Okay, Mike, credit card versus credit line, which will affect your credit score in the most positive way? So your credit score gets affected when you do the initial application. So that's the time it gets affected, and because it will decrease your score. But when you're paying your credit card and you're paying your line of credit every month, that's where it affects it in a positive way, because by paying it on time, you are increasing your score. If your credit utilization was higher than 30 to 50% for around 1 year because you had a secured credit card as a newcomer and a lot of expenses, yes, we are very aware of this, Elena. Thank you. How much time would it take to improve the credit score even if you didn't miss any payments? Elena, it can take months for sure. It can take up to years to get the score back up. And when I say up, I mean, like I said, the average for many Canadians is 650. And typically I've seen where someone haven't managed their credit card, very well. They didn't have good credit habits, and their score was in the 300. So having said that, and it will take time because it can only go up from the 300 for this client as well. And even for yourself, yes, we understand that, you did, if your credit utilization was higher than the 30 to 50%, that's okay, because we understand that that does happen with our newcomers. But again, just do the best that you can, check in with your respective bank and your advisor. As long as you are not allowing it to go you're not paying it, and you're not allowing it to go to a credit agency because you've been paying it, at least pay before the due date. That's all we ask, and that's essentially how you're going to help your credit score. So the bottom line is just pay it off before the due date. Is the free credit report request just done by filling out an online form with one of the two businesses you've mentioned? Or in person? You can definitely call and request it over the phone. I've had clients call and request it over the phone. I'm not too quite sure about online, but I'm guessing when you do call in, you do have a live agent and you can ask them which is the best way. I'm thinking it would be better online because you can do your credit card information to pay for it. So I would call in. You can reach out to me, Holly, after, and I can provide you the information on calling in. You're welcome, Mike. Thank you for the great question. I have a credit line of 20,000. Thank you, Ali Reza. I have a credit line of 20,000, which I have not used since I got it. Is it going to lower my score? It's not going to lower your score per se, but it's not going to help your score in any way because you don't have any activity. So, and it's just going to show you have this and you've never used it. So then by that, when we pull it, your credit report, we can't see the type of person that you are. We can't see your payment, your repayment history. And it's not really going to affect you in any way. It's not going to lower your score. It's just not going to show us much. It's just going to show us, okay, well, you have this. And say you hypothetically wanted to apply for more, we're going to say, okay, you have this 20, you've never used it. Why do you need more? So we're just going to assess your financial history and reputation that way. It's not holding any credit products, a personal credit card, line of credit going to adversely affect credit score. So your credit score gets built by you using credit, Mike. So if you don't have any and you don't use the credit, you're not building your score, you're not helping your score in any way. So you're just if you haven't applied, then nothing gets built. So you do have to apply for the credit and use it in a way of using it. You're borrowing and you're paying it back. You're borrowing and you're paying it back. That's how you're establishing history here in Canada. You guys are asking really great questions. Thank you so much. Now I'll pop in to the chat and see if we have any other questions. Okay, I have a great one from Mayan Kumar. Thank you. If buying anything by credit card and after the next 2 or 3 days I pay the credit card debt is good for credit score. Yes, I think it's a great practice that you have it. You're purchasing with the credit card and you're paying it off again before the due date. So that's a great question. You can manage your credit card that way. Again, what works for you. If you want to pay it off within 2 days, then by all means do so, because at least you're paying it off before the due date. And if you have, depending on the credit card, if you buy something for 500, you can get 500 points that can accumulate and help you buy that ticket or any sort of merchandise you want to pay for online. So I think that brings us to time. We would have to do our wrap up at this point. Here's my contact information. If you have any further questions, you can definitely reach out to me or my colleague. And thank you so much for the wonderful questions. You're welcome, Rabia. Sonia, I'll hand it back over to you for wrap up. Thank you.
Thank you so much, Ria. What a great presentation. I really appreciate it. I'm sure people will take away a lot from it. And again, if you have any questions, you've got the contact information in front of you, and you can email me as well. I'd be more than happy to forward it to RBC. And again, it's nice to have these kind of sessions for our newcomers as well, because this is just as important as employment. I'm just going to let you know that the next webinar coming up is actually tomorrow. And it is based on our LinkedIn series that we are doing. So this is the third of the 3-part series by Khadija Qureshi. And she'll be talking about top 5 LinkedIn myths. And she is our LinkedIn guru. She does great. So hopefully you can join us tomorrow as well. And if you are interested in any of our programs or services, check out our website, have a chat with our chatbot, Vera. She'll be able to guide you into whatever program would be best for you. And again, go to our events page and you can register for the rest of our webinar sessions coming up. If you are on your way to Canada within the next few months, please email cec@accessemployment.ca and someone will be more than happy to start helping you with your job search before you arrive in Canada if you belong to any one of these sectors. And follow us on our social media to find out what's happening here at ACCES. There's always lots of online events, job fairs that are held virtually. So check us out on LinkedIn, Facebook, Twitter, and Instagram. Thank you all for joining, and a very big thank you to Ria from RBC as well.